perhaps it'd be helpful for the appropriate staff persons to speak directly with Mr. Prasant and update him on some of the conversations we've had in a general way, maybe get into some of the specifics in terms of how they approach this specific matter with some of our larger managers and the progress that's being made or not, and they can update you probably maybe to your satisfaction.
Oh, I'm sure.
Not in this
I'm easy
setting.
to satisfy.
Not in this setting.
I just want the information.
Yeah, and I think they have it, and I think it's just a matter of the appropriate way of getting it to you without compromising relationships. Okay. Abigail.
Thank you. And thank you for the historical background. That is really helpful in terms of reaching our allocation goals. But to your Frankenstein benchmarks, as you refer to them, relative to the equity index, I like that private equity is outperformed, but the State Street and the custom benchmark on page 8 of your slide. Could we talk a little bit about what went into those benchmarks? I know, because for all our other asset classes, are those all kind of off-the-shelf benchmarks, and this is our only custom one? Is that correct? No. Are they all customized?
I'll answer. Sorry, for Selman. They're all customized because of the divestments. We've limited some, tweaked some. So, and for the longest time, you had just an equity market equivalent. Mm-hmm. And then we tried to find a benchmark that was a little bit more representative of the universe and have customized that. But literally every single benchmark you have is customized in some way because of our changes.
So then,
just a little more explanation. The
please.
Custom State Street PE index is something we call a peer index. So it reflects investments in the private equity marketplace and what the returns are there. The custom benchmark is what we call a proxy index. So it's based upon the various public equity indices plus some adjustments. So CalSTRS uses two benchmarks, the Custom State Street Index for 10 years and less, and the custom benchmark for longer periods.
And earlier in your presentation, you said that our shorter term, so the State Street benchmark performed lower than the longer term than the custom benchmark. Is that right? Yeah.
So another reason kind of in the industry to focus on a peer index versus the proxy index for shorter time periods is the lag effect of when returns show up in performance. So in a short-term time frame, the private equity, like I mentioned, these commitments are made to the funds, fees are paid. It's a drag before they actually deploy the capital. Over a longer time period, that particular timing issue tends to weigh out. So you can look at it against the public equity index comparable. But in the short term, 1, 3, 5 year time periods, it's difficult to compare a private equity program with public equity, mainly due to some timing differences.
Thank you. And my final question on INV 248, unlike Mr. Prasant, but in terms of our manager relationships, are there items or products offered with these managers that haven't previously been offered that will make private equity, that will make kind of the availability of capital and availability of what we can invest in greater?
Make them greater?
Yeah, like the private capital investments and other types of opportunities that we haven't maybe taken as much advantage of.
So I'd say there's two parts to that. So one is that virtually all of these managers have multiple products that they offer, whether in different geographies or different investment strategies. CalSTRS picks and chooses which ones that they decide to invest in based upon the relative merits of that particular sense of strategy. The other is that I would say that with each of these, the number of strategies has increased, and they're coming up with interesting and new and different ones that have not previously been available. Some of them, the longer dated strategy is something that Blackstone is having, is one of the, Carlyle also has a product in that space. So there will be some things that, working with CalSTRS, they'll be able to evaluate and assess and see if those managers have, their product seems to make sense for the portfolio.
Thank you. And then in your opinion, are there any manager relationships that we're missing? Or do you think that we've diversified enough in terms of the relationship, since the private equity relies so heavily on those managers?
So
Sorry to interrupt. Some conversations are better to be in closed session, and if we're going to name names, I'm fine with that question, but I think it should be a closed session.
I was going
Okay.
to approach it more from a strategic perspective as opposed to a name basis. So the size and scope of CalSTRS program makes it difficult to access certain parts of the private equity marketplace. So just by its nature, it's going to be heavier in buyouts than venture capital. It's going to be heavier in large buyouts than small buyouts. So there's going to be certain parts of the portfolio that are just frankly hard to deploy capital to through fund relationships and through managers. So the staff works to try to take its size and scope and experience and turn that into an advantage, and think about new strategies, think about ways to be important partners with managers like this, so they don't have to pay 2 and 20 fees. They can pay something lower. They can do co-investments, things of that nature. So, the portfolio is diversified. There's a lot of names. There's a lot of strategies that they're pursuing, but just given its size and scope, other investors of the size that, like CalSTRS, it's hard to invest in small market buyouts and venture capital. It just challenges.
Thank you. Thank you, Mr. Chair.
Bill?
Just one quick question. It might be for Margot. Is it correct that Makita doesn't advise you in terms of the reviewing of managers that you're considering?
That's correct.
And so they really only look at the performance and
That's right.
analyze the performance.
That's right. The program is designed so that they're independent and they can evaluate our performance without having been responsible for that performance.
I wanted to put that,
Yeah.
make sure that was there. And then the other question is, who does CalSTRS use as our consultant for reviewing
Yeah. So
potential sponsors?
we have, and our terminology is Makita is the program consultant, and then we have advisors. So our primary advisor is Cambridge Associates. And they fulfill a lot of functions to help staff and also provide the concurring opinion before we make an investment under
Thank you.
delegation of authority.
Thanks.
That concludes the presentation and questions on the semi-annual report related to private equity. The item says we received these semi-annual reports. May the record reflect that we've received them, and we have them, and we've accepted them. I don't think we need to take a vote, but thank you for that. I would like to take a brief break for 10 minutes, and then we'll come back into open session. Thanks, everyone. Appreciate your patience today. There's been a lot of energy and activity in the room. We have some items remaining here in open session, not the least of which is an information item that June Kim and the team will be leading right now. So if we could be, because they're information items and these items will be coming back to us, be really thoughtful about the time factor that we're dealing with right now. June.
Thank you. My name is Scott Chan. I'm the Deputy Chief Investment Officer. I'm going to kick off an introduction and provide a high-level overview. You know that in the last two sessions, staff provided an education on the concept of risk budget, where we said that it could be an interesting new governance tool to complement our existing policies with the benefits of greater flexibility and delegation, increase our risk and return and be able to manage risk more effectively, we could produce greater alignment, as Gail Miller was saying before, explicitly targeting risk with the return targets that we have. We didn't think that we needed to increase risk, but just have a more efficient use of that risk. And as Makita said, it was best practices. So the board put it in its work plan. We designed an 18 to 24-month work plan, and it's going to include a number of topics. We're going to start with June Kim in global equities, but we're going to go asset class by asset class. We'll answer questions about how to set a risk budget for the total fund and for each asset class, how to monitor and report and implement the risk budget. We're going to integrate it with the benchmarks, because benchmarks become even more integral when we execute a risk budget. And then we'll also talk about any changes or effects the benchmarks might have on compensation as well. So those are just among the topics that we've outlined. This is really your chance to ask questions in the information segment.
Thank you, Scott. I'm June Kim, the Director of Global Equity.
And I'm Ray Venner, Portfolio Manager, Global Equity.
Hello, everyone. David Murphy, Portfolio Manager, Global Equity.
As Harry mentioned, this is an education item. We very much want this to be relevant and useful for you. So if it is okay with the chair, I'm going to go over some terminology to make sure we're all on the same page. And then I'd like to pause at that point just to make sure that it's kind of sunk in, and we'll go on from there.
So, thank you, June. And for this item specifically, June Kim will indicate that there will be portions where she's going to pause for questions as different than how we've been running the meeting. So thank you, June.
Thank you. Thank you. I will do a terminology review, and then Ray and David will walk us through some examples. This is a tentative timeline. Today, we're going to talk about changes to the global equity portfolio if we were to move to the use of an active risk budget. At the next meeting in November, we'll come back together with the risk team, Geraldine Jimenez and Josh Diedish, to talk about how the investment committee could monitor the portfolio under the use of an active risk budget. And we will provide some specific examples on reports, how they might look different, and address any questions that come up in today's presentation. And then sometime during the first half of 2020, we will review changes to policy. We'd come back with a first reading of the global equity policy, and then talk about changes that would be needed to other policies, such as the IPMP and also the compensation policy. We're going to cover a lot of detail on this slide. This is the current global equity structure. This structure is a result of our policy, and we also have an excess return target. As you can tell, it's divided into region, US equity, non-US equity, and then also developed markets and emerging markets under non-US. They are essentially managed as silos. So within US equity, I have an active target written in policy of 30%. In developed markets, a target of 50% active, and then emerging markets is 100% active. We have ranges around that, but these are set numbers. We also have set benchmarks in policy, so at each of the US, non-US level, we have a policy benchmark that is in our, policy, and we are measured and graded against that benchmark. When we talk about active in this context, referring to active risk. So that's a portfolio that doesn't look like the benchmark, and the objective is to try to beat the performance of the benchmark. When we say passive in this context, it's matching the benchmark exactly. So in the equity markets, we are able to hold every single name that's in our benchmark in the US index and hold it at the same weights as the index, and the goal is to match the performance of the index. So that's what we call passive investing in the topic that we're talking about today. And as I just mentioned, active, we don't look like the benchmark, and we're trying to beat the benchmark. When we talk about active risk, it's how much deviation are you willing to accept? How different are you willing to look from that benchmark? Because you have to take some type of risk in order to beat the benchmark, but how much? That's the question, and that's the budget that we're going to talk about. I'm going to pause there. Are we good with the terminology? So far, it looks so. Excellent. I'm going to tie this into an example that I've used in a previous presentation, but I think that it helps, or to a lot of people it seems to help. So the way that the policy is written right now, where it designates this 30% active, 50% active, it's very specific. So I'm going to compare it to this diet example, where you have a daily diet, and it has specific numbers assigned to the fat, protein, and carbohydrates, as shown here, 10% fat, 25% protein. And the objective is trying to constrain the total amount of calories consumed in one day. So it's assigning these specific target percents to try to constrain the overall calorie consumption. But there's no explicit constraint on the total calorie consumption. So I could have 1,500 calories in a day, I could have 3,000 calories in a day. It's just these numbers that are set. So that's comparable to the way that our policy is written right now. It could result in high active risk, it could result in low, but it's not explicitly constrained by a specific budget number. This also forces us to have each of these included in the diet, even if there may not be anything attractive available in the marketplace. So maybe there's not any good fats available, and but the way that it's written, it's required to be included. So in the same way, having these targets in our policy, it's requiring certain investments in the active and passive components. What we're trying to move towards is this. Just set what the maximum calorie consumption should be per day. So in this case, I've set it at 2,000, and then leave the actual mix, the percents, to be flexible. And this will allow staff to see what is available in the marketplace, what is attractive, what is fresh in the marketplace. And then as long as we stay within this daily calorie budget, we're within policy. But it does provide more flexibility, but it's actually more explicit in terms of how you are managing the risk. You're saying explicitly, this is how much we're willing to take. And it's also more transparent, because we could also tell you, we consumed 1,800 calories today because of this mix. To tie it back to the global equity composite, what we're proposing, this is what we saw earlier with all these silos, active, passive. We're proposing to take it up a level. So let's focus on just a holistic US equity portfolio where I don't have targets in my policy that I have to be active to a certain percent in all of these regions. And then it'll allow us flexibility to go where we see opportunity. So we won't be forced to invest with an active manager if we don't find an attractive one in US equity. Maybe we can go more passive there and then apply that risk budget that's saved to another region, such as emerging markets or non-US developed. It allows more flexibility. It also brings the focus of the board up to that yellow square, which is at the global equity composite level. And rather than hard targets, we'd be able to move between passive and active strategies depending on where we found opportunities in each of the different regions. And we could even go passive, more passive in one region, less passive in another. The bottom line being more flexibility, which enables us to seek better risk return for the overall composite. I'm going to pause again. Okay, great.
One question. Do we have?
Oh,
We
yes.
do, yeah, hold on. Actually, we have Keith first, and then Bill, if you'd weigh in. Keith?
Okay, on this chart, where it says between passive and active, are there any limits on that? Or at one point, it could be 100% active or 100% passive? I mean, not to say that, I mean, that's an extreme, but I noticed that before, in the carbohydrate part, that chart, you were focusing on the distribution between the three different types of whatever you call it.
Food groups.
Food groups, okay. And then the latter one was about calories, which are kind of like different things. So, but I would assume that under the calories, total calories part, there still are some general. Is it just totally open? So as long as you stay
Well,
under 2,000, you can eat protein?
Right, but the
100%
constraint, Technically, you could, but I don't think that you could do a 100% protein diet and still stay within your budget. So in the same way, I don't think we could do 100% active, given the size of the US equity portion, for example, and then stay within this budget that you've established. That we'll talk about the numbers at the next meeting together with the risk group. But that's the guardrail, that's the constraint, which prohibits us from going, overboard active. It has to be a mix of passive active, but it's not so rigid where it's passive active in US, passive active in developed markets. It could be maybe more passive in US, less passive in non-US.
Thank you.
Maybe just to make a quick comment, echoing June's comments, that how we measure and set the risk target, the risk budget or risk range, that is what's going to constrain this picture between active and passive. And so if with appropriate risk budget or constraint, there's no possible way you'd be able to do 100% active, right? So I think as we get deeper into it, we'll talk about how we go about setting that guardrail that June was talking about.
But this doesn't make it any more likely that we would have higher risk. So in my first example, you don't know how much calories I'm consuming. I could just pile on like really high calorie food because there's no explicit cap. There's no budget limit. Same thing. I could have very high tracking error, high active risk strategies. I am allowed to do that, but we don't have that right now. We have a very large passive component, which keeps the tracking error low. But we think that actually establishing an explicit risk budget number is more transparent and it's better governance.
Bill?
Yeah, one quick question on the emerging markets, giving you the freedom to go between passive and active. I guess my impression is that, it's pretty hard to find because of the lack of efficiencies in that market, a passive, is there a good passive benchmark out there? I mean, a passive vehicle?
There is. Our policy benchmark, our MSCI benchmarks, and MSCI does have an investable index. And in emerging markets, the benefit of doing a passive is that it's huge cost savings, especially given the size of our portfolio. The cost savings are considerable.
How's it balanced now?
It's 100% active right now. Policy has emerging markets as 100% active. And that is an area where I've had previous conversations with the board and subcommittee meetings and other meetings where we should look at adding a passive component just given the size of our portfolio so that we're not forced to allocate to managers.
Okay, thanks.
Gail?
Just another shout out to the staff on this risk budget idea. I think it's pretty remarkable the way you've come up with it and how you're managing to it, and more in terms of the board. I think it's great that the board really is fully aware of the risk and the targets, and I think it's just so much more realistic than the active and passive. So I'm really grateful for your leadership in that, and thank you very much.
Okay, I'm going to hand it over to Ray, who'll go over some more examples and some detail.
Thanks, June. Okay, the clicker. The structure of the global equity portfolios shown on the left results in an active risk that was recently 31 basis points, seen on the right. Let's explore what this means, starting with definitions. Active return is the portfolio return minus the benchmark return. Active returns vary over time and are sometimes high or low, but most of the time are near the average, resulting in this bell-shaped curve shown here. This variation in active returns could be described qualitatively with words such as portfolio returns are somewhat or very similar to benchmark returns. But words are subjective. Different people assign different meanings. So for risk management, it's helpful to use numerical measures. The industry standard is active risk. Active risk informs us of the range of likely portfolio returns relative to the benchmark. On this chart, the average seen in the middle is approximately the benchmark return, the return of the overall equity market. For example, if the global equity active risk is 31 basis points, or about 0.3%, and the global equity benchmark return is 10%, then the global equity portfolio return will likely be within a range from 9.7 to 10.3%. The lower edge of this range, 9.7%, is just the benchmark return of 10 minus the active risk of 0.3%. Whereas the upper edge of the range, 10.3, is the same benchmark return of 10 plus the active risk. A lot of numbers, but the key point is that active risk is a common and useful measure of how closely portfolio returns are tracking benchmark returns. Next, David will describe some implications of an active risk budget.
So adopting an active risk budget is really an evolution, not a revolution of how we currently govern our portfolio. This new framework would accomplish the same objective of constraining risk as current global equity policy, but would give us more flexibility and transparency. So with an active risk budget, what would remain the same? There would be no changes to the GE policy benchmarks and the list of prohibited securities. Also, there's no change how we apply the ESG policy to the global equity portfolio. As for the developing manager program, CalSTRS is committed to diversity in all aspects of the organization, including our investments. We've been a long-time supporter of this program, and that's not going to change. And then finally, it's important to note that the active risk range of the portfolio will remain essentially the same. An active risk budget framework simply makes risk management more transparent and explicit, and we're going to go through some more details of that later in the presentation. So let's talk about what would change with an active risk budget. With the risk budget, the silo approach to managing each regional composite would be removed, and we would be able to allocate to the best opportunities across the globe, regardless of region. As a result, our allocation to active and passive composites may fluctuate over time, and we would have the ability to be able to allocate to a passive emerging market strategy. Another change is that GE reporting would move from a regional focus to a global one. And finally, risk reporting would transition from fixed targets for active and passive exposures to one active risk number for the global equity composite, similar to the 31 basis point example that Ray mentioned earlier. So why would we consider using an active risk budget? I mean, it's what Scott was saying earlier, it's considered a best practice for pension funds, and it would also lead to better oversight and management of the global equity portfolio. And the two benefits I would like to highlight today, or we're going to highlight today, is that it will improve our risk management, and there's also enhanced investment flexibility with moving to this kind of a framework. So I'm going to talk a little bit about the improved risk management right now. With current global equity policy, the allocation target to actively managed portfolios is the primary guardrail for managing the risk of the global equity portfolio. While this method involves classifying each portfolio as either active or passive, it doesn't capture the level of risk of the individual portfolios. At our last presentation in January, we talked about the active risk continuum, where the risk for active portfolios can range from less than 1% for an enhanced index portfolio, all the way up to 10% or more for a highly concentrated strategy. So I'm going to go back to June's food analogy. So the fat represented the high active risk strategies, and the proteins are like the low active risk strategies. So if you look at these two food groups through the lens of our global equity policy right now, it doesn't differentiate between lean chicken and a scoop of ice cream. It considers it the same thing. It's just an active portfolio. So, however, with an active risk budget, the level of active risk of each portfolio would be taken into consideration, and it also incorporates the diversification across all portfolios. So in other words, active risk captures a more complete set of risk drivers. It goes beyond how much we should allocate to an active strategy, and includes the active risk of each portfolio and the correlations between them. We'll pause there just for a second to see if there are any questions.
I think people are good,
Okay.
David, so far.
Yeah, people at ice cream.
I'm gonna go back to Ray.
Thanks, David. Given current policy within each region, as June mentioned, the active and passive portfolios are managed separately in different composites. Removing the target active-passive weights from policy would improve flexibility, enabling us to manage portfolios more holistically, potentially benefiting returns. For example, imagine that policy mandates that we invest 50% of our money in a passive portfolio, as represented by the green square in the lower left. The passive portfolio always matches the benchmark return, so its active return and risk are zero. Suppose we can invest the other 50% into either the high active risk portfolio, the orange triangle, or the low active risk portfolio, blue circle. In this case, we would decide to invest the active in the high active risk portfolio because it has a higher expected return and because of policy constraint. So the passive portfolio and the high active risk portfolio combined give the average return and risk shown by the blend in the middle. But now suppose that we change policy by adopting an active risk budget and by removing the policy target weights of 50% each in active and passive. With the revised policy, in this example, we would fund the low active risk portfolio by transferring money from both the passive portfolio and from the high active risk portfolio. This example illustrates that as a result of the improved policy flexibility, the result is a higher expected return while active risk is unchanged. So
I'm going to jump in because the memo does lay out drawbacks and mitigating factors for each example. So we certainly don't want to give you the impression that this is some type of panacea or, just all good, good, good. I do want to give you a balanced explanation. So I'm going to jump in and just say, in this case, this is an expectation. It's possible that the strategy that we pick could underperform, the higher active strategy. If we were to have more passive than active, it's possible that passive underperforms active. And so those scenarios do exist. I just want to make sure everybody is, I just want to do full disclosure on that.
Okay, I'm going to walk through one final example. So with an active risk budget framework, some emerging markets could be passively managed by staff, which would, one, improve our flexibility, and two, reduce asset management costs. An allocation to passive may be warranted if we cannot allocate to a highly rated manager due to capacity constraints, or if a higher rated strategy is found in another region. Also, internally managing an emerging markets portfolio would cost a fraction of what external managers would charge. As you can see on the chart, most of our assets are allocated to moderate and high active risk strategies. And you also notice we don't have any to passive. So why? And I think June kind of alluded to it earlier. Current policy requires that all emerging market portfolios be actively managed by external managers. So if you were going to ask Chris, he had probably said that these portfolios are active to mitigate potential ESG issues. So we do recognize that we need to address these concerns before moving forward with internally managing an emerging markets portfolio.
David, could you just repeat that last part?
So we recognize we'd have to address ESG concerns before we ran an internally managed emerging markets portfolio. So it could be some kind of overlay, ESG overlay, instead of just the pure emerging markets index.
An active emerging markets manager will hold anywhere from about 40 stocks to large diversified portfolios will hold maybe 150 to 200 stocks. The emerging markets index has over 2,000 stocks. So if we were to hold the index, we're all of a sudden going to increase the number of names we hold considerably.
Yeah.
All right, last slide. To sum it up, the changes that we foresee that would have to take place in order to establish a risk budget, an active risk budget, there would be changes to the global equity policy language to remove references to active and passive target allocations and ranges. And then we would also remove the constraint that emerging markets would be 100% active. We will come back at the next meeting with information about how the committee could monitor this type of active risk budget, some examples of reports, and we'll take your questions and then incorporate that in. We're happy to take questions. Turn it over to Makita.
There are some questions. Does Makita would like to comment? Mika, would you like to comment generally in terms of the direction towards moving towards a risk budget in terms of a governance model?
Yeah, sure. Just very briefly, Makita, as we've mentioned at past meetings, is very supportive of staff's proposal here and considering this move. I think, as it was mentioned earlier, we consider this just an evolution. You have a governance model where the board should be focused on what you have expertise or guidance in, which is setting policy, asset allocation, et cetera. To me, the evolution of staff taking on the discretionary decision between active and passive is a natural progression. And you have a lot of talent here, and they're the folks who are best suited to evaluate those opportunities. So I think that a lot of investment opportunities fall on more of a spectrum as well. So I think the low volatility example is a good one where right now it might not fit in the portfolio, but there might be a place for it with a risk budget framework.
I can't help myself but think it's really us really staying in our lane and allowing more discretion on the sidelines as to what calls the coaches want to call.
One final note that I would make is that I wouldn't want anyone on the board to walk away feeling like this would remove your ability to review how staff is implementing. So I know that staff mentioned some of the tools today, and you'll be hearing from kind of a risk committee in terms of monitoring. But from my perspective, it's simply a new type of benchmark to evaluate execution against, right? So you'd see additional reporting from Makita, you'd see additional information from staff that shows how they're executing within a risk budget framework. So I just wanted to note that as well.
A couple of committee members. Ms. Yamamoto, Karen?
Okay, I guess my questions and comments are the next steps. And I remember Alan Encombe just saying that our purpose is to basically provide benefits and don't worry about what other peers do. Basically, is that what you said, Alan? But I was wondering that for this purpose, because it's so best practices, do we know, can we have, at some point in time, have some comparisons or ranges that other peers are working with so that we kind of have a better idea what we can anticipate, what we can question, or, you know, some of those experiences that they have had?
Yes, we can certainly provide examples of what some other large pension funds are doing. The first one being the one that's just across the river. But then also to bear in mind that these pension funds have different risk objectives, so they may be
Right.
willing to take a lot more risk than perhaps we are. So the numbers that will come back to you next meeting are what numbers that work for us, given our asset allocation, given our risk tolerance, the board's risk tolerance. And so we'll prepare recommended maybe numbers for our portfolio, but we can certainly share what other big funds are doing.
Okay, thank you.
Betty?
Thanks, Harry. I guess my question has to do with timing. And recognizing that active risk is subject to, I guess, forecast error, since market conditions can change pretty drastically. And given that we've been kind of in this longest, economic expansion and kind of knowing that there's going to be a downturn sometime in the near future, just kind of the timing of really considering the change at this point. I know other peers are probably, making the same consideration, but just talk to me a little bit about kind of the timing, why now, given what we know about just some of the downside of looking at active risk.
I'm going to start, and then if Scott or Makita wants to jump in, but 2 points I'd like to make. Even if we were to adopt an active risk budget, we don't anticipate that the portfolio would change drastically. Okay. And it's possible if we add a passive emerging markets, that the active risk could tick down, or maybe we'd allocate some of that to another area. So that's the first thing. You're not going to see some drastic change. It is based on forecast figures, as you said, so it's possible that there's forecast error or that the market is, unusually highly volatile. But we try to use numbers over a very long period of time to smooth that out. And we would have a range within policy, not just like one number, but it'd be a range so that we'd have some, realistic flexibility. Scott or Makita?
I was just going to note from a timing standpoint that I think this is an emerging best practice, right? So more and more plans are thinking of this. And also, if you think about the opportunity set, if and when we see a downturn in the markets, having the ability to consider that ratio of active and passive, and which managers might be best suited to help protect the portfolio in a downturn. I'd actually think that it's relatively good timing to be looking at risk budgeting, and it might allow, again, as June mentioned, not dramatic changes, but an additional degree of flexibility that could really be beneficial potentially in that environment.
See that, okay. I guess the other thing I would ask, if you could come back with is what you anticipate the cost savings to be from reducing the number of active managers. Just give us a order of magnitude with respect to that. And then I wasn't sure, but is there any interaction with the benchmarks that we would use for compensation purposes relative to this change?
The comp policy would have to be reviewed because right now it's based on those silos.
Yeah.
U.S. passive, U.S. active, non-U.S. passive, non-U.S. active.
Right.
It would actually go up to just the global equity level, so it'd have to be reviewed and modified to set the number up at that level.
And maybe I'll jump in with a couple of comments. You might have recalled a pyramid slide that we had shown in the past, and it really talked about how we set benchmarks at a total fund level with the policy benchmark, the strategic asset allocation. Then we go down to the asset class level, then we go down to the sub-asset class level, and then we go down to the manager level. And the board is currently involved in 2 and 3 levels down into that. So the risk budget could provide a governance framework where we could raise the level of where the board is making decisions, and whether that means that it's better delegated to staff. I think that it actually makes the benchmarking process more important, and for us to highlight that and be transparent. And we'll be working with Makita on providing that education, because it's a very important facet. So it naturally, if you change that benchmarking structure, as June was saying, then it flows into compensation.
Okay. All right, thank you.
Bill?
Thank you, Mr. Chairman. Just one quick question back to the passive emerging market manager. As I understand it, you said that one of the limitations may be the ESG policies that we have. And I guess how would that impact our ability to really develop that product?
The product meaning which product, Bill?
The emerging market passive
Okay, I understand. So first of all, if we do a passive emerging markets portfolio, we would manage it ourselves internally.
Right.
Staff here at CalSTRS. And then our ESG policy doesn't constrain it. What we meant is there will be potentially more ESG issues that come up.
Right.
Just because we hold so many more names. We'd still apply the same ESG policy in addressing those issues, but it's possible that the number would increase. So we have to decide, do we go 100% passive? We could do what's an enhanced approach where we'd hold fewer names. Those are some of the things we'd talk through to see the comfort level of the board and what we want to hold.
So those policies will limit the names, obviously, I would think. Those policies would limit the number of names that we would have the ability to invest in.
We could incorporate that into the revision of the GE policy. So if the board decides we don't want to fully replicate the emerging markets index, we're comfortable, taking some tracking error and maybe holding just 800 names or something like that, we would propose a couple of solutions. And based on what the comfort level is, that's what we'd put in. We'd say emerging markets could be run internally at a tracking error of 50 basis points or 80 basis points.
So have we modeled that at all? I mean, have we come up with any sort of projected?
We have been looking at it, and we will share those details with you at the next meeting if that's,
Yeah, thanks.
Chris, if I could jump in and give the quick history. Chris Salmon, Chief Investment Officer. The ESG policy was actually born out of the discussion when the board first went into the emerging markets in equity in 2003. Because the concern was there are good companies in bad countries, and there are bad companies in good countries. And our buddies across the street decided to try and pick countries. That proved really problematic. They got busloads. We have a bus of people, but they had busloads of people way back in 02, 03. So the board decided, you know what, we're going to go 100% active and let the managers make those determinations on ESG. So part of the discussion, as was mentioned, I've been part of their roadblock on going passive because we don't want to own 2,000 stocks and expose ourselves to a raft of ESG problems. But as June and the team have pointed out to me, there are numerous ESG emerging market indexes. So you would still have the MSCI Emerging Market Index, but we could choose to implement an enhanced index that took into consideration ESG. It's part of the fact that that's not passive, but it's really not active. So our definitions are pretty rigid and the labels don't work very well anymore. And I think what I would encourage us to do if we did a internal emerging markets would be to do one of those enhanced index that takes those things to considerations and really factors those through.
Thank you.
Thanks. I don't see anyone else in the queue, but generally speaking, the architects of emerging market index funds, the evolution of that space, have you has there been more recognition or acknowledgement that ESG factors are important to some institutional investors?
With the index providers, you
Yeah.
mean? Yes, they're aware of this. What they have addressed, so there's the purists who are saying an index should just show all what's investable in the market, and they have all launched a series of ESG indexes. And that's something we would take a look at too. And those ESG indexes for investors that want to go into it take these ESG factors into consideration. And then they have their pure index for those who just want pure market exposure across the investable universe.
Yep, thanks. It's just interesting how institutional investors who are looking for specific products, in this case emerging market index funds, potentially could influence providers to talk about environmental and social governance issues that are important to us, and we can have a meaningful impact on
Yes,
important
that's true.
issues.
That's true, Mr. Chair, yes.
Yeah, it's interesting. Okay, thank you very much. Look forward to the next steps in November.
Yeah, thank you.
Thank you. Okay, brings us to our Chief Investment Officer's report. Chris?
Thanks, Harry.
You're welcome.
No PowerPoint this time, and I apologize. Still a learning curve, but we'll be back with it. The numbers in the back of the room that I know Pat Geyer cares about. Pat's back there. The fund is $238 billion. We did touch $240 billion for a day when the governor gave us that extra contribution. But then early that morning before the market opened, somebody tweeted and ruined everything. How does that happen? I don't know. But believe it or not, I've got three names for you. The bottom line is these three things year to date, so in 2019, have returned 23%. Pretty sweet, 23%. The challenge for even myself and all of us is what do they have in common? So if you had invested in long U.S. Treasuries, you would have, up to this date, you've made 23%. That's unheard of in 30-year government bonds. U.S. equity in a strategy called minimum volatility, low vol, has made 23%. Our buddies across the river are famous now because they overloaded that. And then the third item that's made 23%, China A shares. What those three things have in common baffles me, but it is just utterly remarkable. Here are some other quick numbers. These are 10-year government bond yields. USA, 1.5%. I'm sure Glenn can correct me. Probably a little bit higher already today. Germany, negative 0.7. Almost touched 1% negative. France, negative 0.3. Japan, negative 0.3. My favorite, Switzerland. You can give Switzerland your money for 10 years, and they will give it back to you minus 1.1%.
That's why they got so much money.
If you have a small amount of money, you can bury it in a mayonnaise jar in the backyard and do better. But if you have too much money, you have to go with Switzerland. This is a shocker. Greece, as Alan said, this country that now has their act together, I guess, 1.5%, same as USA on 10-year bond. United Kingdom, 0.5%. There's a country that has their act together. Sorry, Kirsty. Don't hate me.
Where's Kirsty?
Higher yielding countries, if you really want to take the risk, Mexico 3.2%, Brazil 3.6%. But it shows you that negative interest rates dominate some of the world's biggest economies, which is just, it was not in the textbooks when I took economics. There was no such thing as negative interest rates. It just could never happen. And even some of the more, I'll say, exciting emerging markets, even though they're investment grade, but Mexico at 3.2%, global interest rates are ridiculously low. And the fact that Germany, France, Japan, Switzerland, most of the Nordic region have negative rates, that's what's putting so much pressure on our Fed to think about lowering rates. And yet, you've got a strong economy. Today, the market was up huge because you had a strong economic number out of jobs. You would normally say, boy, good jobs number. The Fed should be doing just the opposite of easing. But yet, in about 2 weeks, Rosie Lucasini-Jack told me today, there's on September 18th, the market's already fully priced in the Fed cutting interest rates a quarter. So it's baffling, but a lot of it has to do with the strength of the dollar and the fact that you have such negative rates around the world. A couple of more things that I want to highlight for everybody in the CIO report. And I still have the same list of positives and negatives that I have cited before several times. I would definitely highlight the yield curve. Overnight rates, short-term rates are about 2%. Long bond was about 2% when I printed this, but there's a sag in the curve. Maybe think of a hammock. That sag in the middle of the curve drops down to 1.4%. So that's what they mean by an inverted yield curve. The middle of that curve is inverted. And then if you look at what's amazing to me, we always break the market into calendar years or fiscal years, but let's just take a weird period. Let's take 14 months. So we go back to June of 2018, fast forward to today. So a fiscal year and 3 or 4 months, market's basically only up about 5.5%. So our bull market, as I've been saying for a while, really looks like it's running out of steam. It's a very tight seesaw pattern, very hard to have a lot of confidence in it. And as I've said to you before, we've shifted to now slightly defensive in our overall asset allocation. One last thing I want to highlight, and I'm glad it got mentioned earlier when Bill asked what firms did we use to help us manage the private equity portfolio. And I think I'm kicking off what will probably become a tradition for the next couple of months, which is announcing retirements and saying goodbye to people. But Jennifer Arden, if you're in the back, I believe you are, if you would stand up politely.
Jennifer, congratulations.
Under the microphone. Jennifer wanted to say a few words, and I said I'd give her 10 seconds of public talk. No. Jennifer's been with Cambridge and Associates for over 21 years. She's been working on our account since 2003. Just amazing. And Margot put some stats together. During that time, we've committed to over 200 private equity partnerships, over $40 billion during that time period. So we really thank Jennifer for her work with us. And Harry, why don't you come forward? Just her work with us has been a tremendous asset to our team. We still have a deep relationship with Cambridge. And so Jennifer, on our behalf, thank you very much.
Thank you so much. Jennifer, you want a couple?
I would love to. Thank you. That's okay.
It's okay.
No, don't start the crying.
But I just wanted to, it's been such an honor. I didn't prepare this. Thank you. It's been such an honor personally and also on behalf of Cambridge to serve the CalSTRS beneficiaries, to work with this team, starting with the board, and the amount of skill, talent, engagement, and just really staying true north to doing the right thing and doing it in a good way is very exemplary. It's not easy. We've gone through a lot together, and just it's been a fantastic experience. Thank you.
Thank you so much.
Thank you.
say one more quick thing. I just want to call out my colleague back there, because it's an army. So Andrea Auerbach, really, you'll love getting to know her better. And we have 85 people, many of those led by Andrea, and 15 people that have been dedicated to our work with CalSTRS. And Andrea will be leading the CalSTRS work that we do together with you going forward.
Thank you, Jim.
I am, I'm changing it up.
Transition.
I like it.
I like to hear
I'm
that.
still finding the right word.
All right, no, that's good, I like that.
One last thing, I'd like to highlight INV 285. That is, and really the CIO report is not for me. I really want to emphasize it's Josh Diedish, Geraldine Jimenez, Josh Diedish and the team. And I'm going to get them to start putting their name on it instead of my title. They do an excellent job. They really revised this report nicely. But 285 is the beginning of trying to show you a bit of a risk perspective. And we've asked them to work with this, more gauges and more an idea. But as they cited on here, historically, the portfolio has been running at about 140 basis points of active risk. So when we talk about active risk, it will always be in terms of basis points, and I'll go to Ray Venner's slide of range around the benchmark. So you're picking the asset allocation, and that has benchmarks in it. That's how much range we're aiming and taking. And that 140 basis points is built on your current policy statements. With that, I'm open to any questions.